Good afternoon, everyone, and welcome to our first quarter investor call webinar. We have a fantastic panel today, as you can see, to discuss the very fast-changing M&A market in seniors housing, and also want to hear from the panelists and how they plan on fitting into that. But before we kick off the conversation, I'm delighted that our webinar today is sponsored by Blueprint. Founded in 2013 with a mission to elevate healthcare real estate advisory through collaboration and data. Today, Blueprint is the most active advisory firm in seniors housing and skilled nursing, and a market leader within other healthcare real estate subsegments, including behavioral healthcare and medical properties. The firm also offers dedicated capital markets support to their clients with a full spectrum of comprehensive debt and equity solutions, including a new HUD platform. And with a proven track record of over $18.6 billion in transaction volume just since 2013, Blueprint's model combines broad market coverage and unrivaled analytics to deliver results. So thank you very much to Blueprint for sponsoring today's webinar. And representing the firm on the panel today is a webinar veteran at this point and prolific broker, Kyle Hallian. Kyle comes from the REIT world, where he served as Director of Asset Management at Ventas before joining Blueprint in 2021. He's closed over $1 billion of deals during his time there, and he'll be using all of that experience to answer all of my questions today. Welcome, Kyle.
Thanks, Ben.
We have another Ventas alum. Natalie Wynn was the Director of Investments at the REIT until recently, very recently, joining Clarion Partners earlier this year, where she serves as Senior Vice President of Transactions. She certainly has hit the ground running there, as Clarion has just been on a transaction tear in the last 6 months. So she is very much in tune with today's M&A market, and it's great to have you on the panel today, Natalie. Thank you. Next, someone who is still in the REIT world and has been for 10 years now, Lauren Nisley joins us from Sabra Healthcare REIT, where she focuses on acquisitions, asset management, and strategic investment initiatives across healthcare real estate. Sabra completed roughly $450 million of investments in 2025 and expects to exceed that in 2026. So, Lauren, sorry. I'm looking forward to hearing how you're going to be doing all that for the rest of 2026. And thank you for being here.
Thanks, Ben.
Lastly, we have Theo Harrison. He's a vice president at Fortress Investment Group, which has been buying and selling a good amount in the last year. Theo's been with Fortress since 2022, and he focuses on sourcing and executing on opportunistic and value-add real estate investments. Theo, I'm excited to hear about how that's going for Fortress so far in 2026 and how that strategy may potentially change, and also just how you are competing on those deals today with everyone else that's rushing into the M&A market. So it's great to have your insights, and welcome.
Yeah, thanks, Ben.
And to our audience, if you have any questions for our panelists today, you can enter them in the Q&A box in the Zoom window, and I'll do our best to try to address them in the next 75 minutes. We may not get to all of them, but also at the end of the call, a survey will appear. Your feedback is greatly appreciated. We use it to inform our future webinars and future topics. So thank you in advance for filling that out. Lastly, the slides will be posted in the chat feature here. I'll do that in just a few minutes. But if anyone has any questions about Levin Pro LTC, any of the stats you see on the slides here, and our M&A data, just please feel free to reach out to me. My email is on the slides, and that should be it. And it's just these statistics here are just for the reference of our audience. If they happen to pop up in the conversation today, I'm happy to go back to those. But it should be a fun conversation today, as everyone can see, just with the variety of our panelists and the different markets that they're active in. We should be getting a really well-rounded analysis of what's going on in the M&A market, which is currently at record level activity. Valuations are shifting very quickly, and there's unprecedented interest from investors in seniors housing. A big change that's occurred in seniors housing M&A in the last year has been the return of so much institutional capital, targeting a lot of core plus, Class A deals, but also value add deals too. It's adding a lot of competition in the bidding processes. It's forcing all buyers to adapt at least somewhat their M&A strategies. And it's potentially leading more sellers to consider a sale too in the market, which should continue to drive valuations and the quality of assets we're seeing. So, Kyle, I think it'd be great if you could just first set the scene by laying out the different buckets of capital that are most active in the seniors housing and care M&A market today.
Yep, 100%. So, Ben, there's a variety of buckets of capital that's out there chasing deals, right? I mean, you have certainly the publics that have been extremely active. And then I would probably argue that there's different activity levels amongst those peers, all things considered. Obviously, a big shift since last year is the private funds, the large alternative asset managers are certainly re-entering the space in a meaningful way. And then you still have, your family offices and your regional owner operators, as strong sponsors that are certainly active today and chasing the right opportunities for them.
And are there any new, notable kind of capital groups coming into the space, or at least any ones that are making a big return in a big way?
Yeah, 100%. So I'd say today, in 2026, it's mostly returnees, right? I mean, I think you can look at the likes of Natalie's company, Clarion, have entered the space in a big way with a ton of activity. But I think in terms of who's being active, who those groups are, it's a return after a slight pause of being on the sidelines over the years, right? And so I think it's in what has kind of changed, though, is the meaningful shift to operating exposure, right? So RIDEA versus, historically triple net lease opportunities. And then also a meaningful willingness to underwrite future NOI growth rather than in-place yield.
Mm-hmm. Yeah, certainly been seeing that a lot. And then just one last question to you, Kyle, and then we'll go on to the rest of the panel. But are these different buckets of capital, they're not after the same deals? Can you kind of set the scene there of what generally they're targeting?
Yeah, 100%. So I think there's a lot of overlap in investment criteria today amongst a lot of the categories of capital that I talked through earlier, right? And so, from an institutional lens, overlap in, the core plus, Class A opportunities, either full continuum or attractive, ALMC offerings, right markets and right operating sponsors, right? And so, those are opportunities that we're seeing double-digit bids and enhanced competition. I think if you take a step back and look at maybe say some of the larger alternative asset managers looking for platform opportunities, where they can come in and maybe provide a recap for an operator-driven sponsor in a meaningful way with a meaningful check size.
Well, Natalie and Theo, what can you tell me about the value add versus the core strategies? And also, if you can speak on it, the kind of different strategies between closed-end funds versus open-end funds, how that influences maybe deployment pace, giving certain strategies a structural advantage over others in this current M&A market. Natalie, you want to start?
Sure. Thanks, Ben. So I think what we've seen in this current environment really and over the last few quarters is the available opportunity set has really been well suited for the core plus vehicles, which tend to be and can be open-ended, and the publics as well. I think that's been a lot of the activity that's out there. I think in that overlaid with continued improvements in the financing terms, for this type of strategy and product have really given these buyer profiles the opportunity to be quite active, in today's environment and recent quarters as well. I'm curious, Theo could probably speak more to the value add opportunistic side.
Yeah, sure. So, taking a step back, we've been investors in the space since the onset of COVID, kind of in 2020. For the first 3 to 4 years, I think the opportunity set was largely, distressed and value add transactions. To Natalie's point, this has definitely shifted over the past, call it 12 to 18 months. We've seen an influx of both, public and private capital previously sidelined or not as active. That's come back into the space as fundamentals have continued to improve. Going forward, well, I think we'll continue to see value add opportunities. A lot of what's on the market today has been and likely will continue to be the more core opportunities where investors with, lower cost of capital, will be most competitive and will have the ability to build scale, which I think is why you're seeing a lot of that capital come back into the space. There's opportunities to take down larger stabilized portfolios now, and groups that might not have been participating recently want to build scale quickly, and they can do that with kind of the opportunity set in front of them right now.
Mm-hmm. Yeah, and Lauren, speaking of the REITs, how are the REITs competing in the M&A market today? Maybe in general, and also specifically, what kind of advantages Sabra may have in the bidding process?
Well, Sabra and a lot of the other REITs have a really favorable cost to capital. So especially if you're Welltower Ventas, they can pretty much bid on anything and have accretive returns. But in REITs in general, we have easy access to capital, so that means we can close quickly. So that's been an advantage that we've seen on deals we've bid on.
Mm-hmm. And Natalie and Theo, if you just want to touch on maybe your respective kind of competitive advantages that you're bringing in the M&A space to actually land deals.
Yeah, I think especially in today's environment, right, where everyone's sort of on top of each other in terms of pricing. Kyle can probably confirm this, but diligence closing timing obviously is very important. So if you have the ability to close all cash, put on financing post-closing, that's going to be competitive, I think, attractive to sellers. And then, also taking it a step further, whatever the plan is with the operator, if you're retaining the incumbent, that's, generally going to be a competitive advantage. Or if there's a proposed operator transition and have precedent docs in place, to really demonstrate that you can execute on the diligence and closing timeline that you've proposed. I think that's, where you might have an edge in a certain competitive process.
Mm-hmm.
Yeah.
Theo, anything that you would add on Fortress's behalf?
Yeah, sure. I mean, speaking from more of like the opportunistic and value add lens, right? I think our largest competitive advantage that we have is just the ability to problem solve and execute quickly. We've built a very flexible platform that allows us to dig into complicated and hairy situations where traditional investors might pass if something appears too complex. We have our own in-house management platform that we can leverage for certain situations, and we also have very strong third-party operator relationships that we can utilize depending on the situation. We've acquired communities out of receivership. We've solved property level issues that have scared other groups away. We've taken on value add opportunities that require, pretty heavy operational or capital repositioning in order to stabilize. And then obviously on top of that, we've got committed capital that can move quickly depending on, the seller's timeline.
Yeah. So maybe generally speaking, Theo, who else are you competing with for those kind of value add deals right now? Are there other large institutional competitors, or is it a lot of smaller kind of regional players that are competing on those deals?
I'd say it's a little bit of both. I think there's, we see a lot of the same names in the processes that we bid on. I think Focus is a good example, right? They, have a dedicated healthcare fund that we typically run into them pretty frequently. Not so much the larger players that are trying to take down, scale pretty quickly. It's more of, guys with similar thought processes that are going after, the ones and twos or smaller portfolios.
Got it. And then Kyle, I'd love your perspective on this. Do you see Clarion and Sabra competing much on deals? Like, is there some overlap there from your perspective?
Yeah, absolutely. I think those types of opportunities, whether it's 1 to maybe 3 to 4 assets, right? Homogenous product, strong performers, right? New vintage assets, good markets, something that's been built within the past 10 years, attractive, either full continuum or, assisted living and memory care, right? And so I think the big thing there is going to come down to ultimately the markets, and then the operating partner, right? And so the ability to grow with an existing partner and or bring in their preferred manager on the right opportunity, I think you're going to see, not only them, but their peers take a very strong look. Now, what deals are Fortress, Clarion, and Sabra all competing on? Right. I think there's different focus and different strategies that each group has in place there, but I wouldn't rule it out, as a potential option in the future, right? It's probably something that may not be fully stable, but a really good story behind it. whether it's a capital play, an operator change, what have you. But again, I think there are a lot of groups attracted to very similar deal types in today's environment. And depending on the market and the operating partner, I think that really ultimately allows groups to stretch and put their best foot forward to try to compete and win.
Kyle, I feel like we should have had you present a few listings and then had the other three just knock down grudge match over them.
That would have been too much fun. Yeah, we can do that next time.
Yeah, let's just get some footage of the next time the three of them are overlapping on a deal. And I guess, Kyle, are you noticing any difference in the buyer pools for property type, not necessarily quality, but acuity type, assisted living, memory care properties versus independent living versus the full continuum?
Yeah. Yes and no, Ben, right? I mean, I think, again, you have certain groups, let's just take a pure play independent living product or a non-licensed product. That's not for everyone. I think there's a lot of interest in that space, in that asset class. You certainly have groups that, candidly just won't touch acuity right now for various reasons. They want to be attracted to, the earlier demand shift in the baby boomers, et cetera, the higher margin business, low risk profile, et cetera. But I think in terms of, historically, again, you talk to you go to Nick, you talk to most institutional investors, they're looking for major metros and full continuum, but, given the amount of capital out there, which exceeds, the quantity of certain deal types, you're also seeing folks get very aggressive on assisted living, memory care opportunities as well, right? So, Ben, I will say that while the market is active, sellers and brokers and buyers are having a lot of fun right now. Groups are very methodical in their underwriting still, right? Just because you have a brand new asset that's performing well, there is a very micro focus of operating partner, sub-market strength. What does that look like over the next 2 to 3 to 5 years? And ultimately, how groups can get comfortable in the future NOI growth rate there. So, the good thing is for sellers, there's a variety of buckets. We're seeing more and more competition on pretty much every deal type. But again, there is a certain bucket of opportunities that is seeing the most demand.
Yeah. Well, Lauren, I'll direct this next question to you, and then I want to hear from Natalie and Theo too. But what deals do you wish were out there more? And I guess maybe what deals are there just too much competition also in the current market?
Kyle touched on this quite a bit earlier, but we are really focused on those newer assets and secondary markets. I mean, that's our lane. We're not going to compete on the trophy assets and core markets. We leave those to the larger players in the space. So, and we see a lot of volume there. But more is always better, just with all the new competition in the space. So, yeah, that's really what our investment focus is right now.
And for those kind of deals that you wish there were more out there, is the increased competition forcing you to reconsider some of those investments, or like just getting priced out?
I'd say we're getting priced out. But we did 450, as you said, the second half of last year. We're expected to far exceed that this year. So we're still winning bids. And I think that points to our ability to close quickly and the certainty of close, right? We're finding that it's really important to sellers, is that we will do what we say and close when we say we will, and that's really important to us. And then, we're able to be aggressive just because, we look at every opportunity alongside the operator that we want to do the deal with. And so, they know these markets. So we rely heavily on their input as well as the input from our asset management team, who all used to be operators. So we take a really detailed approach to every deal we underwrite.
Good. Natalie, what deals do you wish there were more of them out there?
I'd say, I think right now we wish there was a little bit more of the core plus profile and core plus pricing, maybe a little bit in occupancy margin, meat left on the bone. It feels like, just given all of the the fundamentals and occupancy trends upwards. There's just a little bit less of that, especially that's like a newer vintage, full continuum primary market type of asset. And, if there's something like that, I think we're all going to get excited about it when it's out there. So it's still becoming quite competitive. Where we're going to get aggressive, I think when we're looking at the opportunity set, similar to what Lauren shared, if it's something where we have an existing operating partner that's in that community today, or it's within, a market that they have the boots on the ground already operating in, I think, when you find those synergies there, you're probably going to feel maybe a little bit more conviction if that fits within, your strategy with that particular operator as well.
Mhm. And Theo, if you got a certain deal profile in your inbox right now, what one would cause you to jump off this webinar and answer it as quickly as possible?
Yeah, no, I mean, I'd love to go back to 2 years ago when, I could buy stabilized Class A deals at a 7 cap. That's kind of
Those are good times.
my preferred timeline when things were easy. But I mean, no, today, we're interested in communities that are, well located in affluent markets where we see owners experience the most pricing power.
Mhm.
Obviously we're focused on the value add side. But the deals that get us the most excited, check that affluency box and have some sort of value add component that's either, operational, CapEx driven, or we can plug in, either our in-house manager or the third parties, like I mentioned earlier, to turn things around.
Yeah. And Lauren, you have a couple of new public REIT competitors entering the fray with Janus and National Healthcare Properties. What are your thoughts on them just kind of joining the competition for acquisitions, because they both plan on being very active there? But also, could we see another IPO later this year? Your prediction?
It wouldn't surprise me. I don't know that we'll
Mhm.
see another re-IPO this year, but you know, we'll see. Well, who knows?
Mhm.
But I do, I'm not surprised that both groups came out in the market this year. It's a really attractive market. Everyone's seeing the same demographic headwinds, so it's not surprising, and I'm sure that we'll be seeing them very frequently throughout the year.
Yeah. And kind of piggybacking off of that, are all the REITs chasing the same opportunities? Or maybe how is Sabra distinguishing itself from the other REITs for what you're targeting?
I think we come across Welltower and Ventas, somewhat regularly, but not exclusive, on every deal that we look at. Like I
Yeah.
said earlier, they're focused on the trophy assets, and we just aren't spending our time there.
Haven't they done enough at this point?
Yes, they have. Yeah, it would be nice to see them not competing on those smaller, one to call it four building portfolios and secondary markets, but they're there every once in a while. So it definitely makes it more of a challenge to win in those regards. But we are seeing opportunities where we're coming across a seller that we've transacted with before, and they have that
Mhm.
history with us. And we have, like Natalie pointed to the pre-negotiated documents earlier. That has happened. We've won a deal simply because of that. Obviously, price is a driving factor, but that certainty of execution is huge right now.
Yeah. And Theo, just very generally speaking, I know we've touched on some of these points before, but how do you see this general influx of public capital impacting the broader seniors housing and care M&A environment, and maybe its impact on the private institutional buyers?
Sure. I mean, I think we're already seeing this, but the influx of capital, definitely is going to create a more competitive environment. It will continue to, particularly in the core and core plus deal set, which has led to, significant cap rate compression on the back of, continuing strong fundamentals. We typically see REITs participating in processes that are, one, sizable, and then two, kind of contain assets where a heavy repositioning isn't needed. I think, this may in turn draw more private buyers into the value add opportunity set to a certain extent. But with that, I think that the more experienced investors who've been through this most recent cycle and have, good data with the right operator relationships, I think those are the groups that will continue to outperform in that space.
Yeah, I have been waiting for that, more of the kind of downshift to the value add assets just as a result of pricing.
Yeah.
Kind of waiting for that, maybe a little more in the second half of the year, but we'll see. But Natalie, we've also seen an influx of capital coming from institutional fundraising, and I know you're new to Clarion, but what do you think these investors are most attracted to? And is it specific risk return profiles? Is it certain subsectors? Is it value add strategy or the core plus strategy, or is it some other characteristic?
Yeah, I think as we all know, there's just a significant amount of interest across, various institutional investors, the private wealth channels, and making allocations to healthcare. And I think, right now we've seen a lot of that going into, again, the core to core plus vehicles. And so what they're looking for in that is the appropriate risk adjusted returns. I think that we're going to continue to see more interest and allocation, again, just healthcare and senior housing broadly in the value add and opportunistic vehicles too. So they'll be looking for something else, investing in those buckets. But with the newer investors into the space, I think what's important for them is, a platform that has individuals with experience, background, a track record in senior housing, demonstrated knowledge of the space, as well as like an executable strategy around that too. So I think, the specific returns may look different depending on the bucket of capital that they're investing in. But I think interest. And the other thing I was going to share is that I think, with those that are very new into the space, there's more of an interest and comfort around maybe independent living or a full continuum. I think it takes a little bit more to kind of understand and get comfortable with an assisted memory care, or for those that are doing standalone memory care, we're not really, kind of evolving, going down the acuity as well.
Yeah. Theo, would you agree with that?
Yeah, I think that's accurate. Yeah.
Yeah. And then how do you see the fundraising momentum playing out for the rest of the year and into 2027?
Yeah, I mean, I think strong fundraising momentum will continue probably for the next couple of years. There's definitely a period of time where the broader market was hesitant to, jump back into senior housing after a lot of groups saw their pre-COVID investment struggle. But, since that time, fundamentals have improved materially. And, if you look at Green Street, senior housing is actually the only sector projected to produce double-digit NOI CAGR over the next 4 years, which is driving kind of the investor interest that we're seeing. And I think that, coupled with, the continued lack of development, presents a pretty bullish case for fundraising and investor interest.
Yeah. And Kyle, I want to talk about the direct impact of this increased investor interest in seniors housing on valuations. I know in our most recent SeniorCare acquisition report, pricing rose across all the sectors by record amounts year over year, and set definitely a few records for price per unit, and then cap rates also significantly compressed. Maybe could you share any anecdotal stories of significant price movement just driven by bidding wars?
100%. I mean, Ben, maybe you look back 2 to 3 years ago, you find a really compelling opportunity. You push hard for that 4th or 5th bid, and a decision's decided, via a second round following property tours. Today, when there are opportunities that you get literally 25 bids from 25 qualified buyers, you're seeing those opportunities go to sometimes, 3rd and 4th rounds. And seeing price ceilings that you thought were there, that, get blown up, all things considered. Right. And so, I think overall, it's a great time to be a seller right now. Those that were able to, work their tails off coming out of COVID, inflation, high interest rate environment, et cetera, they're seeing incredible outcomes today. And as all of the group has alluded to, I don't think there's a better asset class when you look from a 3 to 5 year trajectory from, versus senior housing, right? We're at, all-time highs, occupancy wise, consolidated 90%, rate growth, even during the tough times, was consistent. We continue to, press and push the envelope on rate opportunity across the board. And all of that leads to extremely compelling, margin expansion, and NOI growth opportunities. So, again, not all opportunities, Ben, are getting, 20 bids and going to a 3rd or 4th round. We are seeing activity increase holistically. But again, there have been a few fun instances where, Price just keeps going up. And you got to call it at some point in time.
Yeah. Natalie and Lauren, is that getting tiring going through these multiple rounds of bids?
I was gonna, I think a year or two ago, and maybe further back, you'd get guidance right on any opportunity, and you probably felt comfortable submitting a bid 5 to 10% under that, on any given deal. It was like, here's the guidance, and maybe it's going to execute there. Now, if there's guidance, I think you're like, I honestly can't even submit under what that is, and it's probably going to go above. And I think anecdotally from most of the brokerage groups, they're feeling as if they're undershooting on guidance, which, I think we're in a little bit of a different environment today. And you just know that you sort of have to be above that number to participate even in the next round.
Yeah,
Lauren, you agree?
I would completely agree with what Natalie just said. There was a deal very recently where we were told there was a certain minimum we had to be at to get to the second round, and that minimum went up exponentially from what they initially thought, just because of the attractiveness of the opportunity and the number of bids received. So pricing is very quickly getting away from us. So we're having to, really sharpen our pencils to still be successful.
Yeah. Well, my next question may be tough to answer because I know it's always subject to a deal by deal basis, but is there a certain price per unit or a certain cap rate that's just out of bounds for all of you today? Theo, if you want to start.
Yeah, we look at replacement cost as really kind of a benchmark, right? And so when we're looking at the opportunistic deal set, we're not as, necessarily cap rate driven on the go in. We're not the year one necessarily. But it's definitely interesting to see how the price per unit has shifted over the course of time. Previously we could, buy things at what we thought was like a 50% discount to replacement costs. And that's definitely been creeping up, and that's, kind of an ongoing conversation we're having. So it's hard to put, a finger on exactly what our ceiling is, but we've definitely been cognizant of that, over the past 12 months. As fundamentals have kind of driven valuations up.
Yeah. Natalie, any kind of cap rate range that you want to stay within, or the price per unit is probably tough to answer.
Yeah. I know, I echo what Theo said. I think both are the cap rate question, obviously is deal dependent and, may vary depending on the growth profile, and probably looking more at year one as well. I think the price per unit, of course, is just relative to replacement cost. What I would say on that is I think I'm finding the replacement cost calculation is getting a little bit easier than it was, again, a year or two ago, because there's actual development opportunities that are coming out where there's updated pricing. I think we're a little bit, finger in the air trying to figure out what the, updated construction, replacement cost is based on pricing from a couple of years ago, and you have to put some inflation on that. So I think that those price indicators are helpful for us to kind of all better understand where like the true replacement cost is in a particular market, just as there's more development, opportunities coming out.
Yeah, good point. And Lauren, is there any kind of price or cap rate that would make you squeamish at all, or it's deal by deal basis?
It's definitely deal by deal. The per unit prices that are the nosebleed numbers, those are just not markets that we're focused on or assets that we're focused on, because we just know we won't be able to compete on there. So where we are focused, we're still seeing per unit pricing in the 300 to, just over 400,000 range. So we're still at that below replacement cost number. So we're still finding a lot of opportunities in that area.
Yeah. This to the whole panel, Kyle, I know there's no cap rate too low, but what's the new floor for cap rates for the core Class A deals today? And maybe how is that different from 12 months ago? I'm guessing it's significant.
I think it's not so much cap rates on in-place income. It's, really you're putting guardrails on, next year one, year two NOI, right? Everything is situationally dependent, right? Markets, not all markets are created equal. Not all communities are created equal. But I would tell you there's been a meaningful downward shift in that cap rate compression. And I think the biggest difference is 12 months ago, 18 months ago, meaningful focus on what's in place, where now it's how can we underwrite to next year's NOI window?
And I think we can all probably comfortably say that year one cap rate has moved 50 to 100 bips in the core to core plus space, if not more
Yeah.
than just compared to where we were a year ago. It's gone quickly.
Yeah. The speed at which that happened was quite remarkable.
Yeah.
Well, I mean, that's the sudden shift in valuations had to have moved a lot of sellers to the decision that, all right, now is the time. Now is the seller's market. Now I can get the value that I think that my property is worthy of and that I am comfortable exiting. Lauren, from the mind of a property owner and maybe sellers, do you see that happening more and more in the current market? And is that leading to maybe higher quality, better performing properties hitting the market increasingly?
Absolutely. We're seeing higher deal volume than we've probably, at least I've ever seen in my 10 years in the space. I think a lot of those, wait and see sellers are definitely acting now. They're seeing the prices that are being paid, and so they're ready to get their share. So definitely higher deal volume, higher pricing, obviously driven by there's more, not only are there more sellers, but there's more buyers in this space than maybe ever before. So that's obviously going to drive up pricing as well.
Yeah. And Kyle if you agree, has the influx of sellers changed at all the way that deals are being structured or altering the way that sellers are trying to run these processes?
Yep. Again, situationally, I think right now, great opportunity to be a seller, especially for good product, newer product that's performing well. I think you also see, and obviously we're not going to get necessarily hands-on info from that perspective, but I think there's a lot of direct conversations happening, Ben, or processes that are being marketed to a very tight-knit window of investors. And those types of opportunities, right? You probably see the recap opportunity, right? Sponsors that have been in the deal, had the hard work pay off. They want to take some chips off the table, but they're also extremely bullish about the space and want to roll capital forward into those opportunities, right? So again, I think you're seeing plenty of deals. We're all busy. All of our peers are busy. Seeing increasing year-over-year levels. But I do think in select instances, you're either seeing those direct conversations happening because the groups know who the active players are for a certain type, or you're just seeing something marketed to, say, a group of 5 or 10 or less potential investors.
Yeah. And Theo, we've seen a real pickup in portfolio opportunities, portfolios closed, portfolio listings, and some very high quality ones. But for the deals that you're looking at, how are you approaching larger portfolio transactions versus kind of the onesie twosie sales?
Sure. Yeah, I mean, I think the larger stabilized portfolio trades will be an area where we continue to see a lot of competition. Both public and private buyers have been looking to build scale quickly in a sector that, is not a commoditized asset and it's still pretty fragmented. And so these types of trades will enable them to, build scale quickly and continue to grow. From our side, we're more focused on the value add thesis, which I would say more often than not comes in the form of either single assets or smaller portfolio opportunities. There've been portfolios that we've seen that kind of have a value add proposition, but I'd say those opportunities typically contain, less desirable assets that are, quote unquote value add due to, obsolescence or poor locations. On the flip side, though, when we go to sell, there might be an opportunity to aggregate a portfolio for, Sabra or Clarion on the buy, but we're looking more in the optimistic deal set, which doesn't contain as much of the larger scale portfolio side.
Yeah. Well, Natalie and Lauren, what's the appetite for acquiring a portfolio these days? When would that make sense for either of your strategies?
We're definitely open to portfolio acquisitions. We just try not to do anything that's going to be, too big of a splash. The street gets nervous when they see, unless it's accretive from day one, which, we're not going to really see those opportunities. We try to stick with more of the small to mid level investments.
And we're, still early in building out the senior housing portfolio and platform here. So we have to sort of, think about portfolios relative to our, current size. And then, how does that look in terms of geographic diversification and operators as well. In my prior life, there was a lot more appetite for portfolio transactions, and right now too. So, and that they're competitive on those.
And Kyle, are you seeing those portfolios being marketed widely or more kind of direct sales?
Yeah, kind of hit on that point earlier, Ben. Yes and yes. Stuff is going direct, but also at the same time, the market is competitive and there's various buckets of capital that want those opportunities. So why not take it to the market, right? Particularly in the type of environment that we're seeing, right? What I would tell you, though, those portfolios, in order to demand that premium, need to be homogenous. From an asset quality perspective, from a market perspective, from an operator perspective, and a variety of pieces in between. But just because you have a bunch of assets doesn't mean you're going to demand a portfolio premium, all things considered, right? So the big thing on the premium side is really the uniformity of what is being offered.
So if it is homogenous, is the portfolio premium back?
I would absolutely. Yeah, absolutely.
Mm-hmm. Yeah. I mean, there were definitely a few years that the concept of the portfolio premium had pretty much disappeared. So it's good to hear that it's back, and it definitely kind of shook out in our SeniorCare acquisition report this year too. Natalie, a meaningful portion of the buyer universe appears to be getting priced out of the core plus opportunities. There's still plenty of them out there, so not every deal you're getting priced out. And we touched on this earlier, but what have you observed from a sort of downshift in the investment criteria across the market to go down a level in quality or down a level in performance? Have you noticed like a real shift among buyers in that?
I would say a couple things. I think that everyone, we've talked about valuations here. It's very competitive. A lot of people feel like they're getting priced out, especially again, more of the value add buyers. I think everyone who's participating and is active, some are still on the sidelines, for various reasons, are still winning some deals, right? And they're losing out on others. And you're sort of winning where you have the most conviction, again, around a couple of the other, criteria that we talked about earlier. And I think that there still have been, through today, plenty of opportunities that fit the key investment criteria that you would imagine. And I think a lot of groups have similar for the core to core plus strategies, where there hasn't necessarily needed to be a downshift in criteria or compromising on, what the stated buy box is. Now, given again, it could increase competition and, we don't necessarily all know what the opportunity looks like going forward. I think something you mentioned earlier is true, that we're going to see more buyers maybe moving into the core plus to value add space that are currently playing in a different box right now. And then I think also naturally this is going to push, potentially development to commence sooner than maybe others had thought 6 months ago too, just as people are looking to potentially deploy and stay competitive while, keeping prudence to, stay within that, the buy box investment criteria.
We will be touching on development very shortly. You keep like just teasing it a little bit. And I really want to get to it, but we'll give it maybe another 10 minutes. But Theo, you don't want to hear that. You don't want to hear more buyers are going to be entering the kind of core plus value add pool.
No, not necessarily. I mean, in terms of how it's kind of changed the way that we think about, M&A as things evolve. Well, we've largely been more focused on the opportunistic side of things. We also have the ability to play, up and down the capital stack. We've been an active lender in the space as well. So we're always trying to evolve, our strategy to kind of fit the current opportunity set. Additionally, we also recently announced a DST strategy that'll allow us to compete with kind of the more core plus investors and acquire, stabilized cash flowing deals at tighter yields would normally not be a fit for us. So we're always
Yeah.
kind of trying to grow the platform and not, think about ways we can be creative and compete.
Well, Natalie and Lauren don't want to hear that, but oh well. There's plenty of listings to go around. But Theo, with the shift in the market, with the shift in valuations, has it changed at all how you're doing diligence and underwriting deals? Any kind of specific adjustments that you've had to make?
Yeah, so I mean, it's kind of a two-part question. I'd say on the diligence and structuring side, we've got a pretty deep team that allows us to move quickly to identify, attractive opportunities. We've got a large pipeline that we're always evaluating. I think this, coupled with the established relationships that we formed over the past few years, both on the operator side and the lender side, allow us to move quickly through diligence depending on, a seller's time frame. From an underwriting perspective, I think the easy adjustment to point to is on the capital market side. We've definitely seen valuations improve and cap rates compress. We've got, conviction that this trend will continue, especially given the sector's, lack of new development. Operationally, I'd say it's a little more nuanced. Fortunately, we've got a large portfolio to look at and learn from. So we generally want to lean in on, strong demographic market pricing power. Not every asset is going to be growing at, growing revenue at an accelerated CAGR over the next 5 years. And so we, want to make sure that we're positioned in areas where that's, the most likely outcome.
I'll throw the same question to Natalie and Lauren. Any changes in diligence or in how you're structuring deals as a result of the movement in the market?
I would say mostly no. We're underwriting how we were previously, but we are, like Theo said, we're trying to get a little bit more creative. We have operating partners who aren't necessarily interested in just their management fee, and so we have kind of pivoted to some JV arrangements. But our main investment focus has not changed. We're still interested in the same type of assets we were before, the same type of markets. We're still really interested in acquiring skilled nursing facilities. There aren't as many opportunities there that we can compete on, but it's still a primary focus for us.
The lack of listings in the SNF market has been fascinating. I would not have predicted that, but it makes sense. A lot of owners trying to hold on to those assets or refinance them. We got an audience question. Kyle, I'll throw this to you. In states with CON laws, what impacts, if any, are you seeing on deal making or valuations from actual recent changes to laws or potential upcoming changes to laws?
I think in terms of just taking a CON, state like North Carolina, for instance, what you can see there is obviously the supply demand outlook is tremendous, right? There's a finite amount of developable beds throughout North Carolina that can be built. And so while you may have product that is, say 20 to 25 years old, that may not be, top of flavor with all investors, that's the newest product, within that region, right? And so you really give the underwriting confidence that folks can come in here. CapEx is likely a part of the thesis and the strategy, but upon that value add or CapEx play, you're going to be able to underwrite occupancy and rate growth confidently, without having to worry about any sort of supply overhang, right? And so it's always great having an opportunity in a CON state, being able to tell that story effectively to the market. We have a ton of experience on that perspective, so certainly a benefit that everyone kind of likes to see. In terms of the changing regulations, right? I mean, it's in flux, it's fluid. We try to educate ourselves as much as possible. I think one of the greatest aspects about Blueprint is, while we were a national firm, we do have a regional type team model. So we do have subject matter experts pretty much in all parts of the country, right? And so if I have a client that's selling something in, say, California, the Pacific Northwest, I'm going to be able to bring the right team on the field that lives in those markets, that transacts in those markets, and kind of knows the ins and outs in terms of what's happening on the day-to-day, whether it's from a regulation perspective, a new development perspective, what have you.
Great. Well, I hope our attendee is very satisfied with that answer. I think they would be. Lauren, this next question is not really related. It could be tough. But what are you watching most closely that could really meaningfully impact the seniors housing and care M&A market over the next 12 months that isn't something that people are really talking about today?
Well, I think there's a couple things. One, I will say they're probably are talking about it, and one that maybe they're not talking about it but should be. So the first one that they are talking about is interest rates. Now, while that doesn't necessarily directly impact our ability to acquire assets, it does impact, private equity's ability and how active they will be based on the interest rate environment. So that's one. And then the second one that I don't know is on everybody's radar, but we've all seen the headlines about the recent California lawsuits on the regulatory side and how, real estate investors are being pulled in. So that's obviously as a real estate owner, that's concerning for us as other investors in our space are dealing with this directly. So, we're watching what that can do to insurance premiums, and just the overall regulatory environment.
Yeah. No, that's I, I certainly there were whispers of that at Nick, of real concern about that if the judgment is final in the end, and yeah, that could definitely be an issue, or just a general shoe to drop. Well, I don't want to give away maybe one of my predictions later on. Um, this next question is for all of you, and we've kind of touched on each of your investment theses and what kind of assets you are targeting. What will you not buy today, and why? An example would be standalone memory care, or buying in the North Atlanta suburbs, or buying in a non-CON state. Like, what asset or deal profile will you just leave unread in your inbox? Theo, you want to go first?
Yeah, sure. I mean, I think to your point, standalone memory care is definitely a struggle for us. So that's one that we could probably easily check off or tick off the list. More generally speaking, though, I'd say that lower demographic markets, and you probably could have guessed it based on what I've kind of explained earlier, but lower demographic markets are generally a pass for us unless there's a very unique reason for it. Um, we focus on communities in high net worth areas for reasons I previously mentioned, and if you make the decision to stretch into those less affluent areas, you become more susceptible to margin pressure in the event expenses run, which is obviously something we're trying to avoid. Looking at the past couple of years, there was, pretty big payroll surge in terms of, nursing labor, et cetera. And if you don't have a resident population that, can afford to kind of compensate for that to a certain extent, then you stand to get hurt pretty quickly by events like that. That and
Natalie, what about you?
Somewhat similar. I think we are not doing standalone memory care today, just given a focus on a certain, property size unit count. So that doesn't really fit there. We're not active in the skilled market, don't plan to be or intend to be anytime soon. So kind of, similar to Theo in that way. And maybe touching on something that Lauren mentioned in terms of the regulatory environment. Right now, we're just cautiously evaluating certain states. I think there's, nothing is crossed off the list, but I think there are certain states that have tougher regulatory environments, right? Or, larger, of course, government reimbursement, even in the seniors. And we're, pretty focused on private pay. So that, are considerations as well in terms of what our buy box looks like.
Great. Lauren?
I would say similar to what Natalie and Theo said in terms of any standalone product is usually not a core strategy for us. We're not looking for anything too small, call it under 70 units. We're pretty agnostic on geographic location, but we do run climate risk assessments on everything we underwrite. So if it's in, a high flood zone or high hurricane zone, we might just cross that off right away. And similar on kind of the regulatory side of it, like Natalie said, certain states are just tougher. So depending on the product type, we may be more cautious, not necessarily kill it, but be much more cautious and mindful on, the risk and associated cap rate. We're also not looking for deep value add. We need, if it's not accretive day one, it needs to have a really short path to accretion for us. And we're not looking for obsolete real estate either. Maybe call it anything built before 2000 is kind of
Yeah.
an X for us at the moment.
Natalie and Theo, what age do you consider to be old, and then what age do you consider to be obsolete in seniors right now?
I think 20 years is kind of like a benchmark in terms of what we maybe are more interested in buying to not.
Yeah.
I think the obsolete more so maybe depends on the physical plant, whether it's purpose built or not, unit count and size too. And of course, depending on the CapEx history, the community.
Mhm.
Yeah, I would echo what Natalie said. I think that's right. 20 years is generally, where we kind of consider, that floor to be in terms of interval. But obviously, we're a little more hopeful in terms of, an optimistic plan to reposition assets and stuff like that. So we'll definitely play in the 20-year vintage. But to her point, if it's a poorly built, product from the get-go, it's definitely hard to make a case for.
Yeah. And Kyle, are there any listings that are still really tough to get bids in this current environment?
Getting yes and no. I mean, I think it really comes down to pricing expectations, Ben, right? If you have a certain seller that wants a 6.5 cap, for a 50-unit memory care building, right? That's going to be a tough outcome, all things considered. And not all deals are created equal as well. But generally speaking, Ben, there's a buyer for something. There's a buyer for everything out there today. And there's more buyers, today versus not. I mean, kind of hitting on the group here, hit on a lot of the pushback that we get from various prospects on opportunities. It's consistent. I think from the age and obsolescence aspect, it really, to the group's point, it comes down to how the building was built. We have seen a number of high quality 30-year-old assets, that are 1 bedrooms, 2 bedrooms, great common areas, great amenities, the whole 9 yards. And in those instances, those create attractive opportunities despite, the sticker shock of something being on the older side. So, Ben, there's certain deals that are very tough still. Fortunately, more often than not, we're able to get it over to the finish line. I think if we are accurate and price it and tell the story the right way on the front end, we're looking at a finished product and a closing at the end of the day.
Yeah. And I'll spring this question on you. It's not a trick one, but I just haven't heard bid-ask spread being an issue much lately. Would you agree? Like, what's the, I guess, state of the bid-ask spread across the value-add assets and then the core assets?
Yeah, I think you have more of a bid-ask spread on the value-add and opportunistic opportunities, right? Certain price points that sellers just have to be at in order to sell. They would like to sell. They've been in their investment for 3, 4, 5 years, et cetera. But the market's just not there for whatever reason, right? And so, the bid-ask spread discussion around, core plus, I mean, that for the most part's gone, which is fortunate for, sellers and buyers alike. But again, on the opportunistic and value add side, there's just levels that, individuals just can't sell at, regardless of kind of where the market interest is.
All right, great. All right, well, let's move on to development. That was kind of my biggest takeaway from Nick, was that development may be coming back sooner than we may have expected going into Nick, just as a result of the soaring valuations that we're seeing in the M&A market. You're all major capital allocators, but Natalie, I'll start with you. Are you at Clarion becoming more receptive to evaluating ground up development or redevelopment opportunities? And if so, like, kind of what are you specifically waiting to see before green lighting projects like that?
Mhm. Yeah, and I agree. I think I think a lot of us weren't sure exactly when it was coming back, but it feels, I mentioned this earlier, I think the second half of this year and certainly early next, we'll see an uptick in starts. And that's just based on, and you're sort of forced to look at the opportunities as more come in. I think I've seen an increased number of inbounds in terms of development opportunities, and sort of an appetite, I think, from sponsors for either traditional LP equity or maybe some sort of structured investment or mezz. It seems like there's, a willingness to consider different structures, maybe more so in the past, just to kind of start moving development along. And, potentially there's, still compelling risk adjusted returns for all parties there. I think we are, like most groups, again, as I mentioned, kind of evaluating the opportunities. I'm not sure when exactly the right time is, but you're sort of thinking about that compared to, right, the newer vintage core product that's on the market and where pricing is today. And I think that, will again shift people into the development space as well.
Yeah. I mean, I know that the kind of current projects that are out there is giving you more recent comps for how developments cost these days, which is certainly helpful to evaluate whether to go forward with a project. But like, is there a specific price per unit you're almost waiting to see in a certain market before going ahead, or is it interest rates hitting a certain level before going ahead? Is it like a certain amount of liquidity that being able to fund a project? Like, I
I mean,
guess is there something specific that you're waiting for?
there, yeah, I think as the cash flowing opportunities that again still kind of fit the buy box continue to
Hmm.
dry up, right now there's still compelling opportunities on the acquisition side and where you might
Yeah.
deploy capital. And, I think a lot of people are looking at, maybe the spread between the untrended yield on costs to whatever like a going in cap rate is and sort of weighing those and also, right, the price per unit on the acquisition compared to the development cost per unit. I think the per unit pricing of the development, right, will just depend on the market and again, like what the product is, whether it's a premium, ultra luxury. And I think we all, right, will want to pay attention to what's that particular product being built in that given market and does it fit sort of the resident demographic profile that's likely to be the demand there. I don't, there's not any particular numbers. I mean, maybe others can share, and I don't want to speak to specifically, but
Yep.
I think it's sort of a number of different factors that'll, get people comfortable with participating in development in, potentially different ways.
Yeah. Uh, Lauren, what do you think about that?
So I would agree with a lot of what Natalie just said. We still see a lot of opportunities below replacement cost. So,
Yeah.
there isn't a need to kind of take on that development and lease up risk. However, for us, development looks like a preferred equity investment. We're not funding the actual construction. We're not even an LP. So we are getting more active on that front in this preferred equity program.
Hmm.
But, the opportunity, like Natalie said, there has to be the appropriate spread when you're looking at return on cost compared to current cap rates. So most deals don't pencil, at least that we're seeing. But like I said, we have a recent preferred equity investment that we just signed up. We are looking at redeveloping some of our existing assets that maybe just need a different use in order to be successful. We also are regularly looking at our existing portfolio and which assets have expansion potential. So we're really active
Hmm.
on that with at least three of our existing properties. So I'd say that the overall development conversation has become much more active as of very recently at Sabra.
And I'll
Yeah.
maybe add to what Lauren said. I think a lot of the opportunities that I've seen are in those, again, just core primary markets, very affluent, right? Because
Yeah.
that's penciling, and we know some of the starts and higher profile projects that have taken place kind of are again, in those markets. And I think one thing that's been interesting to me too is the execution with the bond financing in the ground up development. And I think that's, starting to drive some of the new starts, right now, while there's still equity kind of on the sidelines in different ways.
Yeah. Well, and the comps that we're seeing that are 800,000, 900,000, $1 million a unit are in those markets, which
Yeah.
certainly help. But then the rents you have to charge, my God, it's amazing. And Lauren, what's kind of the main holdup right now in development? Is it not enough GPs? Is it on the debt side?
I mean,
Just the project's not penciling?
yeah, for Sabra, it's exactly what you said. It's projects not penciling and still having enough opportunities on the acquisition side of existing assets.
Yeah. Yeah. And Theo, how's Fortress approaching development?
I'd say for the moment, we're still focused on buying at a discount to replacement cost Natalie's point. I think that those opportunities are still there. And we're always on the lookout for new development. That's definitely a factor in our diligence at this point, whereas previously, it was kind of something we do, just to make sure it wasn't going on. But now there's a whole lot more, thought that's going into, figuring out what's the ground, what's the hill. Whereas previously that just wasn't something we considered. But for the moment, we're focused still on that deal set where we can get in below replacement cost and feel comfortable there.
I mean, while the deals are there,
Yeah,
makes total sense. And on the Class A side, yeah, Natalie, you're right. The valuations, yeah, we're seeing some comps that are especially high, but when you're talking about replacement cost, a lot of deals still below that.
And to your question about I think at least the opportunity set that I've seen on the development side, anything that's coming across actually has lender interest in financing. It's really the equity piece, right? That's kind of the question mark, from what I've seen.
Kyle, would you agree?
Yeah, it's equity right now. I think the lender liquidity and lender willingness has certainly been a big plus for developers out there today. We are seeing more institutional, public or private groups contemplate development, evaluate development, think about expanding the allocation within their overall pie. You're seeing some projects make sense, and you'll see shovels get put in the dirt. But otherwise, I think it's a pretty fluid concept right now. It'll continue to get more and more thought about and talked about, Ben, as we progress throughout this year.
Mm-hmm. All right. Well, we're at our last question, which may be the trickiest. And Theo, I'll throw it to you first, and then we'll go down the line. But can you make a prediction for the 2027 M&A market? It can be something on activity. It can be something on valuations. It could be a major new entrant. It could be something entirely different. But what's a prediction? I'll hold you to it a year from now. But what do you think is going to happen?
Yeah, so I think this prediction might play out over the next few years, not just in 2027, but I think we're going to start seeing a good bit of performance diversification. This is a complicated asset class that's extremely operationally intensive. There's a lot of new entrants to the space that aren't as well versed in the nuances associated with running these communities. And I think that groups that have truly been on the front end of the sector stand to outperform. Whereas, if you've got groups that are coming in, betting on blind growth, you'll probably face some challenges. These assets aren't commodities. They're very difficult to run, and who you plug in to operate them for you, and the relationship you have is paramount. So if you don't have those right, relationships or controls in place, I think you stand to get hurt. So yeah, I think it'll be some performance diversification. It might not be just next year, but I think you'll see that start to play out forward.
All right, great. Natalie?
I think maybe something a little bit different to go off what Theo said is I think we may see some more operator consolidation or diversification, new operators come into the space again, just as the growth continues in the sector and we start to see, right now everyone's kind of participating in the rising tides, but as things, maybe start to slow, I think some of the true performance or success will maybe show and who's, really poised for growth and those that, maybe need to be more stagnant. So I think that'll create some interesting environment on that side of the business too.
Mhm. Yeah. Intriguing. Lauren?
I'd agree with what Natalie and Theo said. I'm hopeful that deal flow will be just as active next year as it is this year. But I expect that, pricing will continue to inch up. I expect that, we'll still see some new entrants to the market, both in terms of capital and like Natalie said, on the operator side. So it'll be an interesting couple of years.
Yeah. Kyle, you want to rock the boat?
Yeah, let's go with maybe an operator IPO, Ben. That'd be fun. I think that's a real possibility with a couple groups out there. But I think from a capital allocator perspective, it's not. Groups won't be asking in 2027 whether they want to invest in senior housing, but simply just how much exposure they want and with which operating partners. It's again very bullish about the next 3 to 5 years, even if development comes back in a meaningful way in 27. Those starts aren't happening for 2 to 3 years following that, giving a very, very compelling margin and NOI story.
Yeah. I agree with all four of you. I'll throw in my own. Natalie kind of took the one I wanted to do. So I will say that we could have a notable household name announce like their entry into the space with some kind of seniors housing platform, either on the real estate side or something major to do with technology in the community. I'm thinking something like an Amazon, but let's see that. And then this is a little more boring and maybe more predictable, but I think that we could see an increase of the average price per unit for seniors housing assets increase by more than 25% year over year, just based on the fact that there's almost no ceiling for the price per units that will be thrown into the average for 2026. And the floor seems to be rising for the value add assets too, more modestly, but I just think that we're going to see a major increase in pricing across pretty much all the property types, which is tougher as buyers, but then we'll see a lot more development. So it'll be a fast changing market. Well, we are just a few minutes early, but we got through all of our questions, got through the audience questions. And I think we can wrap it up, but I want to thank Blueprint very much for sponsoring today's webinar. Kyle, thank you also for helping assemble this panel of stars. That was a great conversation. Everyone is so relevant in the M&A market today, and it was great to get everyone's perspectives. And I mean, 2026 is going to be very exciting, and 2027, could keep raising the bar too. So Kyle, Theo, Natalie, Lauren, thank you so much for the time. It was a great conversation, and I'll maybe a year from now we'll have to do this again and hold you to your predictions. I don't know about any consequences if you're wrong, but gotta recreate this conversation.
Well, Ben, thanks for having us. Theo, Natalie, Lauren, thanks for joining me. Great opportunity, and I think we'd be glad to run it back 12 months from now.
Fantastic. All right, pencil it in. Well, thank you, everyone. And have a great day and get back to buying.